You know, usually when we look at a rocket launch, there is this expectation of just like absolute precision. The physics are completely unforgiving. It either reaches orbit or it doesn't.
Right, yeah. It's a success or it's a fireball.
Yeah,
The math really doesn't care about market sentiment. It's just clean, verifiable engineering.
exactly. But when you take that exact same company and you transition it into the public stock market, suddenly all of that precision is just, it's gone.
Utter chaos.
Just utter chaos. Today, we are looking at a financial landscape surrounding SpaceX that is, frankly, historically volatile. We're unpacking their Q2 2026 earnings report, this wild post-IPO roller coaster that retail investors are currently trapped on, and an impending share unlock that really threatens to just flood the market.
I mean, it is the absolute definition of market whiplash right now. Just trying to reconcile the engineering reality with Wall Street's expectations it's giving people a headache.
It is. And to figure out what's actually happening here, I've been digging through just a massive stack of data for this deep dive. We are synthesizing SpaceX's official SEC filings and Q2 earnings data, and we're contrasting that with options market volatility metrics from Virginia Business.
Yeah, and we're also looking at historical lockup analyses from IHS Markit and Pure Power Picks.
Right. And layering in deep dive financial reports from Sacra, Value Add DVC, and Crypto.news. Because our mission today is to help you, the listener, untangle this massive web. We need to figure out if SpaceX's staggering valuation, which, by the way, is hovering around $1.5 trillion right now.
Insane number.
Right. We need to know if that's actually justified by the technological leaps they're making, or if a, quote, manufactured scarcity IPO combined with a massive influx of locked-up shares is just setting retail investors up for a massive crash.
Which is a vital question for you to understand, because when you separate the stock chart from the launch pad, the sheer scale of SpaceX's operations is staggering. Like, we are talking about scaling AI compute clusters, pushing past 12 million global internet subscribers, and launching rockets at a cadence that entire nation-states cannot rival.
So let's unpack this. Because even if you don't actively trade individual stocks, you really need to understand the mechanics here. SpaceX successfully lobbied for a fast-tracked inclusion into major indices, like the NASDAQ 100.
Oh yeah, so they're everywhere.
They're everywhere. That means whether you realize it or not, this extreme volatility is likely sitting right inside your 401k or your passive index funds. The risk is systemic.
Yet you really can't ignore it just because you aren't day trading it.
So before we even look at the Q2 earnings numbers, we have to establish the intense market environment that's dictating how those numbers are being received. This stock has been on a violent ride over the last 2 months. Let's set the timeline.
Let's do it.
SpaceX IPO'd on June 12, 2026 at $135 a share. That made it the largest IPO in history, valuing the company right out of the gate at $1.77 trillion.
But the crucial context there, and we can't stress this enough, is how they IPO'd. They utilized what NYU professor Scott Galloway called manufactured scarcity.
Right, the float.
Exactly. They only made about 5% of their total shares available to the public's float. And, the float just means the percentage of shares actually available for the public to buy and sell on the open market.
Which is an incredibly constrained supply. I mean, typically you see companies float at least 10% in an IPO, often way more. Established tech giants like Apple or Nvidia have over 90% of their shares in public circulation.
Yeah, so you had this massive pent-up global demand to own a piece of SpaceX, but only a tiny sliver of shares actually available to buy.
And that supply-demand mismatch just forced the price up, right to an intraday peak of $225.64. Which, by the way, made Elon Musk the world's first paper trillionaire in the process.
Wild. But, artificial scarcity only works until the market rationalizes the underlying value. Since that peak, gravity kicked in pretty hard.
It did. The stock plummeted roughly 40 to 50% heading into this Q2 earnings report. And Virginia Business highlighted just how much anxiety is brewing on Wall Street right now. They reported a 34% short interest as a percentage of the float.
Wow. Over a third.
Over a third. To put that in perspective, that means over a third of all available shares have been borrowed and sold by traders who are actively betting the stock will crash. They have to buy those shares back eventually, which creates an incredibly combustible environment.
And the auctions market was pricing in a massive 15% move in either direction based on these earnings. I mean, that implies a $225 billion swing in market capitalization in a single day.
Just staggering volatility.
The tension was so high that Musk actually took to X to warn short sellers they were making a catastrophic mistake.
Well, putting my market analyst hat on for a second, I have to challenge the foundational valuation here. When you look at their S1 prospectus, the document they filed to go public, they claimed a total addressable market, a TAM, of $28.5 trillion.
Yeah,
dollars.
that's the number that got everyone's attention.
But 25.6 trillion of that is attributed entirely to AI. Is that real, or is Wall Street just hallucinating a future that doesn't actually exist? Because analysts are sharply divided on this.
That is the trillion-dollar debate right there.
Yeah.
You have highly respected critics like Aswaf Damodaran, often called the dean of valuation, and research firms like Cape Fear Advisors arguing those AI claims are vastly overstated.
I mean, they have a point.
They do. Cape Fear specifically pointed out that the advertising-subsidized AI model is currently dominated by Google. And in the enterprise space, SpaceX's AI subsidiary, xAI, only has an annualized revenue run rate of about $500 million.
Right. Compare that to a competitor like OpenAI, which is doing roughly $25 billion. Claiming a $25 trillion TAM when your actual AI revenue is $500 million seems, well, beyond plausible to the bears.
Sure, but the bulls are looking at a completely different layer of the technology stack. The bullish argument is that SpaceX isn't just trying to build another software chatbot, right? They are building the underlying physical infrastructure for the next generation of global computing.
Which brings us to the actual earnings. With the market bracing for impact and short sellers circling the wagons, the Q2 numbers finally dropped. Let's look at the hard operational data. Did the underlying machine actually work?
Top-line revenue was a massive beat. They surged 92% year over year to $7.814 billion. That completely shattered the Wall Street consensus, which had them pegged somewhere between 6.8 and 6.9 billion.
And their adjusted EBITDA hit 3.538 billion. And for those listening, adjusted EBITDA is basically a metric used to measure a company's raw operational profit before things like taxes, debt payments, and depreciation muddy the waters.
Right, the core money-making engine.
Exactly. Plus, they are sitting on a war chest of $100 billion in cash and securities, partly bolstered by a recent $25 billion bond issuance. They have serious, undeniable capital.
And this is big, but if you just glance at the headline numbers, you'd see that they reported a net loss of $541 million, which seems completely contradictory to a massive revenue beat and strong operating profit.
And here is the massive plot twist I found buried in the Crypto.news report. That $541 million loss is essentially an accounting illusion.
Oh, really?
Yeah, it all comes down to Bitcoin. Under new FASB accounting rules specifically, fair value accounting for digital assets companies now have to mark their cryptocurrency holdings to the current market price every single quarter.
Oh, wow.
Yeah, they have to run any drop in value directly through their income statement as a loss.
And SpaceX holds a significant amount of Bitcoin on their balance sheet.
Yeah?
18,712 Bitcoin to be exact.
Right. So over this specific quarter, the price of Bitcoin dropped significantly. That translated to a $540 million paper loss for SpaceX. So if their total reported net loss was $541 million, and the Bitcoin paper loss was $540 million.
The core operations of SpaceX were effectively break-even. That accounting quirk completely masked what was actually an incredibly strong operational quarter.
It did. So let's break down the mechanics of where that operational money is actually coming from, segment by segment.
Okay, so the true engine of the company right now is Connectivity Starlink. This brought in $4.291 billion in revenue, producing over $1.65 billion in operating income. They doubled their subscriber base year over year to 12 million.
That's huge.
It is. To give that context, Value AdBC had estimated they might hit 7 million in 2026. They obliterated those projections.
And they are maintaining an average revenue per user of about $66 a month. That is a real, sticky, cash-generating subscription business.
Absolutely. Then we have to look at the AI infrastructure segment, xAI. This generated $2.561 billion in revenue, up 247% year over year. But the truly staggering number here is the spending. Yeah. They poured $15.8 billion into AI CapEx capital expenditures in a single quarter.
That level of spending is just astronomical. I mean, they are building out massive compute capacity. Their Colossus II supercomputer just reached 1.4 gigawatts of capacity.
Which is insane. Just a power that requires the equivalent electricity of a medium-sized city.
Right. They also announced a $60 billion acquisition of the AI coding tool Cursor, and they have $14.1 billion in contracted sales. That includes massive monthly cloud compute deals with Anthropic and Google.
But that 15.8 billion in spending is exactly what invites the skepticism you mentioned earlier.
Precisely. Are they actually building an impenetrable AI monopoly, or are they just becoming a commodity neo-cloud provider? Because short seller Jim Chanos suggested exactly that.
The neo-cloud critique.
Yeah, a neo-cloud provider basically just buys a ton of NVIDIA GPUs, racks them in a warehouse, and rents out that computing power to third parties. Commodity hardware businesses usually get valued far lower on the public markets than frontier AI software companies, simply because anyone with enough capital can buy servers.
Right. Chanos calls it a don't look at the man behind the curtain situation. But the counter-argument the bulls make is that compute is the new oil.
Okay, how so?
Well, by building out gigawatt-scale infrastructure, SpaceX isn't just renting servers. They are attempting to become the foundational utility layer of the entire AI economy. They want to own the power generation, the specialized cooling infrastructure, and the massive real estate footprints that make frontier AI possible at all.
And all of that infrastructure relies on one crucial bottleneck, actually getting things into orbit. Which brings us to the segment that started it all, space. The launch services.
Yeah, they reported $962 million in revenue here, with 78 launches in just the first half of the year.
But they also posted an operating loss of $542 million for this segment. Now, we know the reusable Falcon 9 rockets save them a tremendous amount of money on a per-launch basis.
Yeah.
So seeing a $500 million operating loss threw me off for a second.
Until you look at where the research and development money is going.
Right.
It is all flowing into Starship V3. This is their next generation, fully reusable, super heavy lift vehicle. Aggressive R&D costs billions now, but the mechanics of Starship are designed to fundamentally break the cost curve of spaceflight later.
So synthesizing the financials here, the earnings were fundamentally stellar. Starlink is printing real cash flow, the AI revenue is scaling rapidly, and the net loss was just a Bitcoin accounting anomaly. Operationally, the underlying machine is working.
Firing on all cylinders.
Yeah. Yet, immediately after these earnings dropped, the stock sank 7 to 8% in after-hours trading, falling back down to around $116, below its IPO price. Why? Because the market isn't looking at the operations anymore?
No, they're looking at the calendar.
Exactly. They are terrified of the impending share unlock.
We have to transition from company fundamentals to market mechanics here, because this is where the physics of the stock market take over.
Think of the IPO lockup period like a massive hydroelectric dam holding back a reservoir. When a company goes public, insiders like the founders, early employees, and venture capitalists are legally prohibited from selling their shares for a set period.
Right, to prevent a crash.
Exactly. For months, only a tiny trickle of water, that 5% public float we talked about earlier, has been allowed through the spillway. It prevents insiders from cashing out on day one and instantly tanking the price.
But for SpaceX, the first major lockup tranche expires on August 6th, just 2 days after this earnings report. The floodgates open. Roughly 911.5 million shares become eligible to trade.
Wow!
Yeah. At current prices, that is over $100 billion worth of stock suddenly hitting the market. This effectively doubles the current public float overnight.
The dam breaks. And according to the filings, there was actually a provision for an extra 10% of shares to release early, but it failed to trigger.
Why did it trigger?
Because the stock was required to trade 30% above the $135 IPO price, which it couldn't hold. So thankfully for retail investors, the flood isn't quite as bad as it could have been. But look at historical comparisons of other small float IPOs unlocking.
It's usually brutal.
It is. When Beyond Meat's lockup expired, the stock fell 22% in a single day, even though they reported strong earnings that exact same day. Rivian fell 21% on its unlock day, and it was already down 75% for the year.
Yeah, although you do have counterexamples like Facebook. They used a highly staggered lockup system, releasing shares in smaller waves over time. Much like SpaceX is attempting to do with this first tranche, Facebook stock actually rose 13% on its biggest unlock day.
Wait, it went up?
Yeah, because the market was relieved the selling wasn't as bad as feared.
Okay, but let me push back using the efficient market hypothesis, which the IHS market analyst brought up. The EMH theory basically argues that if all information is public, it should already be perfectly reflected in the stock price.
The theory, sure.
Right. Everyone in the market, from retail traders to massive hedge funds, knows exactly when this August 6 unlock is happening. It's written in plain English in the SEC filings. So
Hmm.
shouldn't this massive price drop already be completely priced in? Why do we consistently see stocks fall on a day everyone knew was coming?
Because the efficient market hypothesis assumes perfectly rational actors and perfectly elastic demand. In reality, behavioral economics take over, especially with a stock as emotionally charged as SpaceX.
Right.
The IHS market data point out that while the event is known, the magnitude of the actual selling is entirely unpredictable. Like, are early employees going to cash out to buy houses, or are they holding for a decade? Will early venture funds distribute shares to their partners who will then immediately dump them?
Right, you have these massive downward sloping demand curves. When you suddenly ask the public market to absorb double the supply of shares, demand doesn't magically double at that exact same millisecond.
Exactly. Institutional investors understand these mechanics. So what do? They step away. They stop buying in the weeks leading up to the unlock, just waiting to scoop up those shares at the new, lower equilibrium price. The fear of the drop causes the drop. It becomes a self-fulfilling prophecy.
It is the ultimate tug of war between strong underlying operations and just brutal market supply mechanics.
Which is why, to survive this near-term lockup volatility, investors have to stretch their horizon.
Yeah.
Where is this $100 billion cash pile and this aggressive R&D spend actually taking the company by, say, 2028?
Let's forecast. Let's look the moonshots that justify the long-term thesis here.
It all comes back to Starship V3. Flights 12 and 13 recently showcased two critical mechanics: precision landings and in-the-base engine relights.
Explain why that's important.
Well, relighting an engine in the vacuum of space proves you can maneuver massive payloads between different orbital trajectories. The ultimate goal here is a 99% reduction in launch costs compared to historical averages. If they can achieve that kind of scale, they are genuinely pushing toward having boots on the moon by 2028. It fundamentally rewrites the economics of doing business in space.
And back on Earth, their enterprise and defense dominance is expanding rapidly, too. Starshield, which is their highly secure, encrypted satellite network for government applications, just won a $6 billion Pentagon deal.
Huge contract.
Right. And their partnership with T-Mobile for direct-to-cell service is now actively covering 500,000 square miles of cellular dead zones in the U.S.
But here is where the mechanics get truly sci-fi. A report from Saccharin notes that SpaceX is in active talks with Google to put AI data centers in space.
Orbital data centers.
Yes. Furthermore, in July, SpaceX apparently revealed a secret prototype for a consumer AI handset, like a phone designed to bypass traditional smartphone makers entirely, connecting directly to the Starlink satellite constellation and xAI's compute network.
Okay, I have to apply some serious practical skepticism here.
Yep.
Launching servers into orbit sounds incredible on a whiteboard. But is it actually a practical solution to our terrestrial power grid constraints? Or is it just a recipe for the most expensive, unmaintainable data center ever built?
Well, the maintenance.
I mean, think about the physical mechanics. If a server rack breaks in a data center in Memphis, you send a technician down the hall. If it breaks in low Earth orbit, what do? And more importantly, cooling.
Yeah, cooling is the massive engineering hurdle. A lot of people think the vacuum of space is cold, so cooling servers would be easy. But the vacuum of space actually acts as a massive insulator because there is no air to carry the heat away through convection.
You essentially have servers trapped in a giant thermos.
Precisely. To cool a data center in space, you have to build massive, specialized radiators to convert the heat generated by the GPUs into infrared light and beam that light out into the void. It is incredibly complex.
So why do it?
The bullish argument is that in space, you have access to 247 uninterrupted solar power without atmospheric interference. More importantly, you bypass all terrestrial red tape. No waiting 5 years for a grid interconnection, no local zoning laws, no water usage restrictions.
Oh, I see.
But that entire thesis relies completely on Starship V3 actually working and bringing the mass to orbit costs down to near zero. If Starship fails to scale, the orbital data center idea is dead on arrival.
Which perfectly encapsulates the ultimate valuation debate right now. Wall Street models are completely torn. You have Starlink alone generating a $15.5 billion full-year revenue runway, which is undeniably incredible. But conservative analysts like Morningstar put the fair value of the entire company at just $780 billion. Meanwhile, underwriters like Morgan Stanley have modeled it reaching $3.4 trillion by 2040 based on these exact AI and space compute synergies. It is a massive spread in expectations.
So if we pull all of these threads together, what is the ultimate takeaway for you listening at home?
Operationally, SpaceX is a machine functioning at the absolute bleeding edge of physics. Starlink is a cash-generating juggernaut. The AI computing revenues from Google and Anthropic are scaling rapidly, and their reusable rockets dominate the globe. But public markets are a different beast entirely.
Completely different.
Right now, retail investors are caught in a violent tug-of-war between unprecedented AI capital spending on one side and a massive, imminent share supply shock on the other.
And as you navigate that volatility, I want to leave you with one final thought to mull over. If SpaceX successfully deploys this orbital AI infrastructure, and if they launch their own consumer handset, they won't just be an internet service provider or a rocket company anymore.
What will they be?
They will own the entire vertical stack of the digital economy. Think about it. They will own the power generation via space-based solar. They will own the compute layer through XAI. They will own the transmission layer through Starlink. And they will own the end-user hardware.
A completely closed loop.
Exactly. So the question you have to ask yourself is, what happens to the global tech ecosystem when a single company, firmly controlled by one individual holding 82% super voting power, can completely bypass terrestrial infrastructure, cellular towers, and traditional internet regulations entirely?
Usually when we look at a rocket launch, the success is binary. It reaches orbit or it doesn't. But with SpaceX, the public company, we aren't just watching a launch anymore. We are watching them attempt to build an entirely new atmosphere. Thank you for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we'll see you next time.